So good morning, everyone. Let's start our Thursday morning session. We have a session on debt for climate swaps and JETP real options. So we have three speakers. We have Professor Jakob Mulugetta, who's a professor of energy and development policy at the University College London, member of the management team Climate Compatible Growth, founding member of the African Climate Policy Center, ACPC, at the UN, and the Economic Commission for Africa, and former senior climate and energy specialist from the ACPC. And we also have Chavon Rogers and Adrina Abida, that are both PhD candidates in the Department of Economics at the University of Massachusetts Amherst. So we have 20 minutes for each, more or less, and then in the final time we open for questions and discussions. Thank you.
Thank you. Thank you. Good morning, everyone, and I hope you had good breakfast. I'm Jakob Mulugetta. I'm very pleased to be here, and thank you so much for this opportunity to be able to have this discussion around finance. It's something that I come across quite often in the work that I do on energy. Whenever a discussion around energy is picked up, whether it's at the COP or anywhere else, almost inevitably the conversation veers towards finance. And many of us find ourselves rather frustrated about that, but nonetheless, that's where we are. But also nice to be in this wonderful university, which has such a track record, particularly when it comes to development economics. What I'm going to talk about really is just reflections around debt for climate swaps and the JETP as a way to try and sort of set the scene, and it's really my kind of personal reflection on it. But before kicking that off, like many of you, you know, the climate agenda is something which we can't, you know, walk away from, even though northern governments are beginning to, you know, hand over their responsibility, and somehow we find ourselves in this crisis moment where that responsibility seems to be, or running away from that responsibility. But nonetheless, you know, climate change, you know, in terms of extreme weather and adaptation costs are going to increase quite significantly, particularly in regions where capacity is quite weak and where institutions are also weak, unable to be able to withstand the pressure from extreme weather conditions. Of course, underlying that is the perennial debt crisis that most countries are faced with, particularly in Africa. More than 50, 60 countries at high risk of distress, where we've talked about, you know, debt services exceeds the cost for education and health in several states. With this, you know, we have discussions around energy transition. How do you make sense of even talking about energy transition under those type of conditions? And in addition to the fact that we have quite a heightened geopolitical tension that is in many ways serving as, you know, obstructing any kind of positive move forward. Now, the other aspect, of course, is the other contradiction is that you have countries such as my country, Ethiopia, which has low greenhouse gas emissions footprint, while at the same time it is highly climate vulnerable. And I think that's, Ethiopia is not unique in that sense. Most countries in Africa and South Asia find themselves in that position. And then, of course, with this is that, again, coming back to the whole discussion around finance, often the term innovative finance is thrown around, and it baffles me sometimes that the word innovation is often used when it comes to challenges of the poorest countries. I mean, I live in London. I don't hear about innovative finance for climate services or innovative finance for energy transition in the UK, but somehow countries such as Zambia or Belize are forced to think innovatively as though innovation only belongs to them. What essentially it means is that the rules that apply to others don't apply to you, therefore you have to think outside the box, it seems to be what the thinking is. Now, just as we talked about the 100 billion pledge. It's this magic number that has been with us for the past 15 years. And it would be worth to sort of reflect how that 100 billion was actually agreed. Some of you may recall this was the Copenhagen COP15, I believe this is 2009. This was a period when, Barack Obama had won the election that same year. The presidency, the Senate, as well as the House was in the hands of the Democrats. So there was quite an optimism of some kind that as we were entering into the COP. But what I remember was also this call, particularly from the global South, largely led by two individuals. This is Lumumba Ping, who was the chair of the G77 plus China at the time. And he was presenting a very strong position around reparations and around questions to do with a certain proportion of global GDP should be transferred to the global South to be able to do adaptation and mitigation, et cetera, et cetera. The discussion was around 5% at the time. Now, if you calculate that, that's quite a significant. So there was some ambition in the dialogue. At the same time, there was also the Prime Minister of Ethiopia, and he's someone who was mentioned a few times in this meeting over the past few days, Meles Zenawi, who was leading the African heads of states on climate change. So he was the voice coming out of Africa. And those two gentlemen were actually interacting quite strongly over the course of the year, building up this expectation from the global South. And so during that first week, Lumumba was, trying to mobilize civil society and everyone else around the issue of finance. And Meles Zenawi was yet to arrive the second week. Now, funny thing happened during that weekend. And that was when Meles Zenawi traveled to France to have a discussion with Sarkozy and various others on the position that Africa had taken. And of course, everyone expected that he wasn't going to break away from what Lumumba was arguing, that there is a very strong global South position. Now, he arrived on the Wednesday and delivered a speech that completely floored everyone. It was a total departure from what was already being discussed. And that's when, the $100 billion, the first time it was mentioned was in his speech. And quite clearly what had happened is that there had been some deals that were done behind closed doors with northern governments. Obama was also present. And some things must have been promised, because just under a month later, a country that Ethiopia was in difficulties with, Eritrea, was handed sanctions. Now, that may be coincidental, perhaps, but nonetheless, what happened was that we saw in COP15, it exposed both the potential and fragility of multilateralism, but also the tension between, pragmatism in the way that Meles Zenawi presented his argument and principle. This is the one that Lumumba was positioning. So I think, what we see there is even, within the global south, there has never really been a strong unanimity around the climate agenda. And also, I think one thing to make a point is that the COP is a place where some really bad agreements actually happen. And there's a reason for that. There is the politics, the high politics behind it, which tends to undermine any type of technical discussion around the climate. And therefore, we come up with the $100 billion, the short-term finance, loss and damage. You've seen what kind of figures are being, what we're playing with when it comes to loss and damage, $700 million to solve this enormous challenge. So I think this was really to try and contextualize the $100 billion discussion, how it came about, but also behind it that there is some high politics that led to that. And this is something that I think Jayati mentioned it, that most of the cumulative annual global greenhouse gas emissions or carbon dioxide emissions equivalent has happened in recent years. So I mean, if you look at it, between 1750 and 1990, we're looking at roughly half of the emissions were emitted during that period of time, that 200 plus years. Since 1991, more than 50% of that has been emitted. Yeah. Many reasons for this, of course. A lot of it is to do with the way in which, I mean, yes, if we were to take a consumption-based type of accounting, the way in which it will, this will divide up will quite clearly be in, the global north would take the greater responsibility of it. But often what in IPCC and other places, the production-based accounting is the one that's used. And of course, that points fingers to countries like China and India and so forth and so forth. Yeah. In terms of, more the recent emissions. It's something, to keep in mind. But of course, then, if we begin to start talking about, the richest 1% being responsible for 15% and the richest 50%, etc., that gives us a totally different picture altogether. So I think we should be doing some real numbers when it comes to consumption-based accounting and the way in which it should be used as a way to communicate the imbalance that we see today. So it was a long journey to where I needed to be. What are debts for climate swaps? So these are the two things that we wanted to cover today. This is the debt for climate swap and the JETP. Well, the debt for climate swap, in short, is a way by which the creditor essentially swaps or restructures part of the country's debt, and in exchange, the country commits to spending on climate-related conservation or biodiversity. Yeah. Now, this can be in direct bilateral, where a country either forgives the debt or cancels the debt, or they restructure it in a way that countries pay less interest on the debt that they have accumulated. So there are different ways by which this plays out. So it's bilateral or third party, where NGOs and financiers enter into the discussion, where they support countries to buy their debt at discounted rate, and begin. But the real crux of it is that the money that is actually generated out of these transactions would be used to support biodiversity or some other climate resilient type of activities. Now, what are the JETPs? The JETPs are different in the sense that these are a partnership. This is something that was put together during one of the COPs, recent COPs in I think in Glasgow, 2022. But these are large funding packages, but they're completely different in the way that what they represent. And this is, 4 countries were the ones that qualified for this: South Africa, Indonesia, Vietnam, and Senegal. But essentially, this is really to help countries self-define or define their coal phase-out pathways and build a low-carbon transition. Within this, of course, is the whole discussion around justice when it comes to jobs, and communities would need to be part of this this pathway. On the face of it, both appear to be win-win, where poor countries get fiscal relief for new finance, and rich countries get they get climate progress. But the question is, are they real options? But what is the attraction of it? They both link 2 things. One is the urgent crisis of debt, and it links it with the climate crisis. So swaps, for instance, they free up, as I was saying, some of the fiscal space, whereas JETPs tend to mobilize billions for energy transition. Both of them carry the language of partnerships and resilience and just transition and green finance and so forth, and promise, again, to solve 2 interrelated challenges. The question is, what is the politics behind it, and do the figures make sense? Now, in terms of reality check, what impact are we looking at? I think colleagues are going to be doing a more deep dive into the cases of these. But one of the things is that when it comes to the debt for climate, we're looking at very small amounts of money, essentially. So Seychelles, for instance, it's the total amount that we're talking about is 21 million. Belize 360, and Barbados, which is the large one, around 300-400 million. I think the more recent one is Ecuador, which is fairly large. But when you look at the share of their overall debt, we're looking at quite a small amount. So in many ways, we are still at the piloting stage of these swaps. The JETPs are larger. South Africa, for instance, the pledge made through South Africa is 8.5 billion. Indonesia and Vietnam are around 20 billion. But the other thing that was never fully disclosed at the COP is that these were going to be, much of this was going to come as loans, not grants. And also, when you look at the bigger picture in terms of, South Africa's transition would require something in the order of 100 billion dollars, but the 8.5 billion doesn't really quite do what the country needs. So the scale is something which is quite small to really make some major impact. And of course, the benefits are for the creditors is that they offload some of their risky debts. They score, of course, green reputational points. And in terms of the JETPs, is that the donor countries benefit in many ways. For example, a lot of the technology transfer is actually coming from their tied, to their own industries, for example. Now, the other question is also, are poor countries paying twice? And in some cases, yes, that a lot of countries find themselves in a debt situation, largely to do with the fact that their economies are struggling, and many have had to borrow to be able to deal with climate impacts. In some cases, also to be able to mitigate again, to be able to push against flooding, for instance, that we saw in Pakistan. So the climate extremes require some resources that countries have to use, and of course, in many cases, what then tends to happen is that they enter into debt And so now the question is, in order to be able to pay that debt, do you go into further debt through climate swaps? So we have quite a number of examples. The examples are not the same types. They are quite specific to countries. Barbados, for instance, its latest one is looking at debt for climate and the investment would be for waste management of its, to build an infrastructure to manage waste. And it varies, from one place to another. I'm nearly there. Could these tools be designed differently? Perhaps is the question. What we can say. But one of the things but there would need to be a number of things that would need to happen. The first is, of course, large-scale cancellation is important, not just retrofitting what already exists. The second is, of course, the country-owned climate funds. And the other thing is also when countries have to use. When countries have to be forced to invest in an agreed biodiversity project, what it does is that it pushes them away from their own agenda, and therefore it is, it isn't by choice, that they're having to invest in waste management. It is an agreed agenda between the creditors and the country. So there isn't as much agency in it for countries. So what we'd suggest is, of course, more grants and fewer loans if we are seriously talking about making some headway here. And then this means, of course, recognizing that much of the debt for many countries is climate driven, finance for adaptation and resilience, not just for coal phase out. And then finally, the question around collective bargaining. Maybe this is something that we can talk about, that often, countries are having to deal with debt by themselves. But is there some other political way by which, collective bargaining can happen, where countries can say collectively, what happens? 50 to 100 countries decide, agree, and say, we're not paying this debt under those current conditions. What would happen? I think this is some question that we have to deal with. Thank you.
Thank you, Professor Jakob. So now we have Shabron. Thank you. So I just press G. I just press this.
Hi, everyone. So I'll be looking at the feasibility of debt for climate swap in the Caribbean, and see if this is an instrument that can be used to mobilize climate civilization investment and also debt relief in the region. Okay, yeah. So the Caribbean and natural disaster is intertwined. From 2000 to 2003, the region has experienced around 793 climatic events, most of which are storms or superstorms, costing over $180 billion. Now, the impact of climate disaster is estimated to be 22 billion annually. It will be around 22 billion annually by around 2050. And the cost to stabilize and mitigate against these shocks is around $100 billion, equivalent to 1/3 of the region's economy. There are studies that shows that to make housing much more resilient to these shocks, so people do not become homeless after a hurricane or any natural disaster, in the Bahamas, Barbados, Guyana, Jamaica, Suriname, and Trinidad and Tobago would cost around $2 billion annually. And for the energy transition, it's $1.2 billion annually that is needed, which is 16 times higher than what is currently being invested. Therefore, the demand for climate finance is very high in the region. And what's preventing the region from actually investing in climate is the fiscal space, the external debt, basically. So 33 small island, of the 33 small island states that was examined, 12 of them could be categorized as under debt stress or already in debt stress. Now, if you look at the public debt per GDP within the Caribbean region, it is not as high or alarming. It's 69%, and if you're not a fiscal hawk, that should be fine and be able to work with. However, we have to look at the flip side. Majority of the debt is in dollars, and it is the servicing and the trade-off of servicing your debt or investing in your people that weighs on the Caribbean. But also during times of crisis, it impacts the fiscal space of these countries. Specifically, the revenue generating aspect of these small island countries. In another study, I did an events study that shows that after extreme weather shock, the revenues that is generated from import and export decrease, and this decrease has a 5% window. So after 1 year of an extreme weather event, it ripples throughout the economy for around 5 years. Similarly with tax revenue generation. So natural disasters have a systemic impact on the fiscal space of these countries, therefore hinders any real investments and exacerbates the debt crisis within the region. However, there are several channels, quote unquote, to use that could generate climate finance. There's loans, there's grants, and there's comprehensive debt restructuring. Loans exacerbate debt crisis, so we don't necessarily want loans. Grants is much more favorable. However, it does not addresses the debt crisis within the islands. And debt restructuring is far from, it's not necessarily an option that the region has been granted often. Throughout the years, only 39 debt restructuring took place, and only 2 of which had some debt cancellation. And it's not a complete debt cancellation, it's only partial debt cancellation. Therefore, the new instrument, debt for climate swap, was introduced as a magic cure to both the debt issue and also climate stabilization, seen as this new innovation. And over the years, debt swap have been increasing in popularity. However, is debt swap feasible for the region? To answer this question, we have to look at the country's debt composition, who are the creditors, and the instrument, and go instrument by instrument, which makes debt swaps much more complicated because external debt is not held by one creditor oftentimes, and then it becomes much more complicated. We also have to look at the impact that debt for climate swap have on liquidity pressures. It's often good during the time of liquidity pressures. It's a good instrument to use for short-term maturity and also high interest rate instrument as well. And it's ripe for external debt. Therefore, the Caribbean seem to be a great region because of this for an instrument like this. Typically, there are 2 types of debt swap. You have bilateral, where you go directly to the sovereign debtor country and creditor country, and they'll reduce your debt directly. Or you can have a multi-party type of approach where some third party mediates the purchasing of the debt. This could be through grants and also concessional loans or some guarantor type of agreement. So the third one seems to be the one that is most fitting for the Caribbean region. And there's several advantages for that to have a third party buyback loans for the Caribbean. One, it increases the volume in which they can access credit-wise. It also is argued that it mobilizes private finance to help with that. And it also has an opportunistic window regarding market conditions when the debt buyback is much favorable to increase cost-saving mechanisms, which would increase climate investment. There's an argument that debt swap could help with credit rating. However, it's a bit tricky to argue. There's several conditions in which it should be met for it to be a positive regarding credit rating within the region. Oftentimes, these countries should not be in debt stress in the first place for the credit rating to be positive, which does not necessarily bears true, because if you're going into any type of debt restructuring or climate debt swap, you're somewhat in liquidity pressure already, and that is why you're going to get these types of debt swap. And there's the disadvantages that many of us already know about, which is the limited cash that is granted through debt swap. However, with the Caribbean, the external debt in the grand scheme of things is pretty small compared to the capital that is out there. And so you'd expect that, okay, the Caribbean should be ripe for debt swap because the external debt in the grand scheme of things is not that high. However, comparatively for these small island states with small economies, it is burdensome. Therefore, debt swap should be reasonable. Negotiation is pretty hard, and the cost of transaction is also burdensome for small island states as well. So it becomes an issue compared to traditional liquidity management types of operation. However, because the Caribbean has a regional institution, this might be mitigated if a regional institution is established to deal with debt pressures and debt issues, particularly with the administrative side of climate debt swap. And this is one way in which the region can go about this as well. The conditionality on risk that debt swap often comes with is an issue that also needs to address for climate debt swap to be feasible within the region. It does not give these small island states flexibility. And one of the flexibility that I would hope to see within these debt swaps as they become much more prevalent is that it links the debt restructuring or the debt buyback to specific sectors that are damaged oftentimes to climate disaster, i.e. tourism, transportation, and health, oftentimes are burdened during these crises. The debt rigidity of debt swap that can come with debt swap should also be mitigated for it to be feasible within the region as well. And greenwashing of projects during the debt swap stage. Oftentimes, administrative costs is burdensome rather than the actual projects themselves. So that oversight needs to be looked at as well for these instruments to be feasible in the region. Now, I want to look at 3 Caribbean countries specifically that I think debt swap could be one instrument that could be used to help to lower not only the external debt crisis, but also help with climate stabilization policies. St. Vincent and the Grenadines, Grenada, and Dominica. They're high debt stress countries, external debt stress to be exact, and the premium that they pay on these debt is often high, hovering between 6% to around 8%. some time. And even though they have concessional loan guarantee because they're under the DSA framework, these concessional loan does not take into account the economic pressures that often comes with climate shocks. As I showed you earlier with the event studies, after one climate disaster, there's 5 years of economic downturn regarding the revenue generating aspect of these economies. And so if you look at the framework for Dominica as well, a large portion of their debt is held, external debt is held by the World Bank IDB agent. Similarly to St. Vincent and the Grenadines, a large portion is held by the World Bank IDB, but also the Caribbean Development Bank as well. And Grenada, similarly, IDB is a large debt holder for external debt for them, but also the IMF and the Caribbean Development Bank. So multilateral institution plays a heavy hand in external debt within the region, specifically for these small island developing states, who often rely on citizenship by investment to mitigate some of the shocks through that happens through with the tourism sector and other export generating sectors. So, and which has its own problematic outcome as well. So I want to look at Grenada at a closer look. The debt burden in Grenada, it's mostly the interest that Grenada has to pay on these external debt that increases the burden that they face. And because of that, they often fail to pay these debts, particularly if you look at their bilateral debt payment, even with regional partners. Trinidad and Tobago, for instance, in 2020, they owed around $16 million. And now in 2023, the last, it's $35.7 million. And this is because of the interest increase and them foregoing on these payments as well. So how does debt for climate swap comes into play with, say, a country like Grenada and the high external debt that they face? So Grenada, with quote unquote a low external debt in comparison to other countries that have a much higher external debt, their debt is low enough for the traditional debt for climate swap to satisfy relief per se. Debt for nature swap could also focus on the arrays in Grenada, and this could help them to pay off these debt faster. And there's precedent to this. Belize and Seychelles did use part of their debt for climate swap to pay off some of those types of loan. Also, debt for climate swap could focus more on the flexible interest rates that the Grenadian government incur, where these flexible interest rates also plays a key role in destabilizing the economy during shocks as well. So debt for climate swap could also focus on these flexible interest rate. Debt for climate swap could also focus on the coverage that cat bonds should be able to cover. So using these debt swap to increase the coverage for like the World Bank cat bonds, but also removing the triggers, because it is the triggers that are actually harming relief as well. So soften the triggers, removing the wind measurement as well, and tying the damage to households and also revenues in specific sector, particularly in health and tourism as well. So tying the damage to wind, and if the eye of the hurricane passes over specific geographic regions in the island, remove those triggers to specific sectors as well. Also expanding the Caribbean catastrophic risk insurance facility is also a good use of the debt for climate swap as well. So this could be done using the SDRs as well. The SDRs are good guarantors to hold on to as a third-party support as well. So I'm not sure if you guys are familiar with the Bridge Initiative by Barbados. And what they're saying is that you could use $100 billion of the special drawing rights through multilateral lending agency. What I'm proposing is that if debt for climate swap will become a major tool within the Caribbean region, Caribbean governments will need guarantors to back these types of saving, quote unquote, saving mechanism. These SDRs could be used as some sort of guarantor mechanism to back these types of saving mechanism as well. And Barbados is a good example of mechanism of quote unquote saving. Recently, they're the last Caribbean country that engaged in some sort of debt for climate swap, and it's projected that they'll save fiscal savings of $125 million rather, and this was backed by IADB and European Investment Bank. This climate swap is very interesting because it was led by a few regional institutions. Therefore, the regional mechanism is also there to support these types of swap as well. However, they have to focus more on the high interest rate. They have to focus more on the high interest rate instruments rather than the lower interest rate instrument. And Barbados tried to do this, focusing on the 8% interest rate instruments. And they also have a grace period as well, and a disaster clause that I feel should be implemented in all debts for climate swap within the region, that if there were to be some natural disaster, a grace period of 5 years based on the event study that I showed should be given for the economy to recover. Specifically, industries such as health and the tourism industry as well. And this 5 years grace period will help with repayment of not only bringing down the stock, but also help to the economy to recover as well. So for me, the debt for climate swap, it's not a silver bullet that will save the Caribbean, not only increasing climate investment, but also with debt stability. But it's one tool that can be used if it is restructured in a way that speaks to the needs of the Caribbean region. One, you should ensure that it looks to the harm that is caused by the harm that is caused by natural disasters to specific sectors, specifically tourism and health. And two, it should focus on debt that is burdensome, particularly external debt that is held by multilateral institution. Now that is tricky because a lot of multilateral institution debt is senior. So removing the senior clause on these multilateral institutional debt could also help to free up a lot of fiscal space as well within the Caribbean region. And in that case, the climate debt swap could be useful for the region and a feasible tool for not only climate stabilization investment, but for also debt stability investment as well.
So we have Adrina now, but she's online.
Good morning, everyone. I hope you can hear me.
Yes.
Awesome.
Yes.
Yes.
Okay. I deeply regret not being able to be there in person today. My sincere gratitude to Jayati and Chandru and everyone on the team for making this possible and giving me the opportunity to share my work here today. All right. So let me start with a quick overview of debt for nature swaps. We know that these are agreements.
Adriana, can you just wait for like just wait for a minute? Just for a minute.
Yeah, for sure.
Davi, você está escutando ou não? Tem como expandir a tela dela ou não?
A tela dela precisa ser expandida, Carol, aí no computador do auditório. Você pode ver que do lado direito tem um chat, né? Se vocês clicarem em cima do ícone do chat privado, ele vai recolher, e aí assim a imagem fica maior.
Tira daqui? Como?
Fala, Davi.
Tudo bem, Juliano?
Opa, vamos lá.
Vamos lá, ó. Você está do canto direito, em cima do relógio aí, olha, você tem uma barra com bastante texto.
Certo.
Que é a barra do chat. Você vai encontrar uma barra, uma linha escrito chat privado do lado dele.
Sim. Tá
Clica no
nela
chat
já.
privado.
Já tá.
Clica de novo.
De novo.
Ele precisa recolher esse texto aí. Não está recolhendo?
Não tem um xizinho, alguma coisa para fechar?
Ou faz o seguinte, para o mouse em cima do vídeo dela. Você vai ver que na parte inferior direita vai aparecer um quadrado pequeno.
Aqui.
Isso, aí você clica que ele vai expandir a tela cheia.
Davi, a gente precisa aumentar um pouco o volume aqui dos falantes. Sabe como? Ou tem que chamar alguém?
Dos falantes do auditório?
É.
Pede para o Júnior, por favor, que ele mexe na mesa. Enquanto
Beleza,
isso, a Adrina pode seguir com a apresentação dela.
Tá bom. Beleza, então. Só isso, né?
Só isso.
Valeu.
Thank you, Adrina. I think we can start now.
Okay. All right. Thank you for getting that fixed. All right. So as I was saying, starting with a quick overview of what debt for nature swaps mean. So by now we know that these are agreements where part of a country
They are going to increase.
Where part of a country's debt is reduced, canceled, or restructured in exchange for a commitment to invest in conservation of key natural resources. So these were first introduced in the 1980s during the Latin American debt crisis, and since then their scope has broadened to include not just conservation, but also in recent times.
Sorry, Adrina, can you speak a little louder because or increase your volume because here your voice is coming very low. Can you speak a bit louder because your voice is coming very low here?
All right, I will try my best to speak louder. Is this okay?
Yeah.
Awesome. Okay. All right. So the appeal of these debt for nature swaps is straightforward. They promise both debt relief and financing for the protection of key natural resources. Importantly, these swaps also promise hard currency relief by allowing debtor countries to repay obligations in local currency, easing the strain on foreign exchange reserves and sometimes even improving their credit ratings. So more than 30 countries have already implemented these agreements. Between 1987 and 2015, these swaps restructured over 2.6 billion US dollars of debt and supported about $1.2 billion worth of environmental projects. All right, to understand how these swaps work in practice, it helps to look at the mechanism. In many cases, a multilateral public or private fund acts as an intermediary between the creditor government and the debtor government. The process usually begins when the fund explores interest on both sides for a possible swap. Once there is interest, the fund helps mediate negotiations of the terms between creditor and debtor governments. This results in a partial cancellation of bilateral debt. Instead of paying back the canceled portion in foreign currency, the debtor government commits to disburse an equivalent value in local currency to an existing public or private fund. That money is then directed into agreed conservation or climate projects within the debtor country. The multilateral fund, in this case, also plays a role in accountability, making sure the resources are allocated as agreed. From the creditor's perspective, the swap can then be reported as official development assistance or ODA. So I want to highlight the long-standing existence and evolution of debt for nature swaps. While they've recently been popularized by the private financial sector, it's important to remember that since 1987, many such agreements have been signed, and their effectiveness and implications deserve closer scrutiny. So the very first debt for nature swap took place in Bolivia in 1987, and during the 1990s, these agreements gained attention as an innovative mechanism. But they were also limited. The debt relief amounts we saw were small, the transaction costs were high, and there were ongoing concerns around sovereignty. By the 2010s, their popularity declined. At that point, more comprehensive debt restructuring initiatives like the HIPC initiative or the Multilateral Debt Relief Initiative took center stage and overshadowed swaps as a tool for easing debt distress. Since 2020, however, we've seen a resurgence. This new wave is larger in scale and often linked to refinancing private sector loans through green or blue bonds. It also emphasizes de-risking for investors, and agencies like the UNDP have suggested that substantially larger deals could contribute both to easing debt distress and mobilizing new climate and conservation finance. So while debt for nature swaps are not new, they have re-emerged in new forms. The important question, though, is whether this resurgence actually addresses the limitations we've seen in the past, or whether old challenges remain under a new label. So several analysts have highlighted the limitation of debt for nature swaps, and one of the most comprehensive assessments comes from Fresnillo's 2023 Eurodat report, and many of these limitations have already been discussed by my presenters. So I will move on to my study. In my study, I take a slightly different approach to understanding the limitations of debt for nature swaps by asking simple fundamental questions. First, have these swaps substantially reduced the external debt burden? In other words, the debt question. And second, have they led to effective and enduring conservation outcomes? That is the nature question. The ability of these swaps to jointly and adequately answer both the debt and nature questions is crucial. It helps us gauge whether new debt for nature swaps can be strengthened and positioned as viable alternatives for climate finance. Finally, it is imperative that we critically examine the recent trend of financialization in conservation financing, especially the increasing role of private financial institutions in these swaps. So we start by looking at the case of Indonesia that signed 3 swaps between 2009 and 2014. We focus on the scale of debt reduction achieved by these swaps, potential for interest payment savings, and hard currency relief. Indonesia's swaps were part of the first wave of debt for nature swaps that started in the 1980s. As you can see from the table here, it shows the swaps signed under the US Tropical Forest Conservation Act. And as you can see, they reduce only a tiny fraction of the debtor country's external debt stock. For most countries, this reduction was under 1%. Bolivia's first swap in 1987, which was initiated during the Latin American debt crisis, relieved just 0.16% of its debt. Even in later years, countries like the Philippines experienced near zero debt reduction. It is important to remember that external debt is accumulated over many years. A single swap, no matter how well-intentioned, cannot substantially change the overall debt picture. Instead, if we assess the impact of annual debt service, most swaps still delivered modest relief, often less than 1% of the debt service in the year prior. Some countries like Madagascar and Guatemala in later years achieved slightly higher reductions of 4 to 6%, but even this represented only a small dent in overall debt obligations. Only a few countries such as Botswana saw swaps that accounted for a larger share of debt service, around 16%, but these were exceptions rather than the rule. Our case study of Indonesia also showed no different. In 2009, the US government forgave 6 debt claims against Indonesia through what was at the time the largest debt for nature swap, reducing 30 million in debt payments. This was followed by 2 more swaps with reductions of 28.5 and 12.6. All 3 swaps were worth less than 0.03% of Indonesia's external debt stock at the time. So the mechanism of the swap at the time involved depositing a lump sum amount into Indonesia's debt service account to close out the debt. But crucially, Indonesia still had to pay installments of principal and interest without a grace period. Moreover, the agreement required debt service payments to be made in US dollars, so there was barely any immediate, meaningful hard currency relief. In 2011, the US-Indonesia swap, several INGOs in the US contributed 23.76 million, which resulted in a reduction of 28.5 million in debt. The outstanding obligations that were canceled and replaced amounted to 27.45 million, meaning around 1 million of the debt reduction accounted for canceled interest payments. However, according to the swap agreement, the new obligations consisted of 27.45 million in principal and 2.6 million, a higher amount to be paid in interest payments directed towards conservation spending. So owing to a less than optimal impact in addressing the debt question, it now becomes imperative to shift our focus to the nature component of the 3 swaps with Indonesia. So while it is true that the swaps help redirect government expenditure into conservation programs, it is important It is important to recognize that such expenditure may not entail additionality. At the country level, the swaps could potentially replace other conservation-focused interventions and may not be considered as extra measures. Additionally, these swaps do not inherently lead to increased financial resources being directed towards conservation within recipient countries. When faced with an externally mandated payment schedule, the government might opt to reduce its own conservation efforts and cut projected budget allocations. All right. So the 2011 Indonesia Debt for Nature swap represented the first initiative with a specific focus on REDD+. The funding was directed towards conservation of forests as well as support of sustainable practices. However, a crucial characteristic of these first wave swaps was that there were barely any monitoring measures set in place. Therefore, it becomes difficult to ascertain whether the swaps achieved what they set out to do. So in order to see whether these swaps resulted in a significant reduction in deforestation, we look at the trend of the dominant drivers of annual tree cover loss in the country. The swaps in 2009, 2011, and 2014, here indicated in green, roughly coincide with temporary declines in commodity-driven deforestation, and Indonesia initiated the swaps to protect 13 forests in Sumatra, and these swaps aim to curb deforestation in these forests. However, the monitoring shortcomings of these swaps challenge the effectiveness of these conservation efforts. So a more in-depth analysis was actually carried out on the conservation efforts for Peru's Debt for Nature swaps. So these swaps were also part of the first wave of Debt for Nature swaps and led to a face value reduction of 14.3 and 25 million, roughly equivalent to 0.1% of Peru's external debt. Now, the conservation funds were directed towards reducing unauthorized timber extraction in 2 key forests, which were subsequently designated as protected national reserves. However, these conservation efforts were minimal in scope relative to the funds allocated. 3 of these projects supported only the construction of guard posts along rivers at critical access points to deter illegal loggers. The analysis of the tree cover loss trends within these 2 protected areas, situated in the Ucayali region of Peru, reveals a concerning pattern. In the figure, the yellow bars indicate the years the swaps took place. The overall trend in tree cover loss within these protected areas exhibits fluctuations, with a general upward trajectory suggesting that deforestation has been persistent. 3 significant spikes in deforestation were observed in 2005, 2012, and 2019. So this observation raises doubts about the effectiveness of designating these areas as protected and the efforts as simple as construction of guard posts in actually reducing deforestation. Now we move on to compare the achievements of the second wave of debt for nature swaps to the first. So Belize signed 2 swaps so far, one in 2001 and another in 2021. So the experience from the 2001 swap was similar to the others we've already discussed: insignificant reduction in external debt, minimal conservation efforts, and a lack of monitoring. In 2021, Belize entered into a novel debt for nature swap agreement, which highlighted the evolving complexity of transactions that involve commercial debt and private intermediaries. So a special purpose vehicle called the Belize Blue Investment Company provided a $364 million blue loan to Belize. This loan underwent de-risking by the US IDFC, which insured it against political risk. So Belize used $301 million of the loan to buy back its original $553 million super bond, which at the time made up about 30% of Belize's GDP. Beyond that, $24 million from the blue loan was placed into a conservation endowment fund, $18 million to subsidize lower interest rates in the early years of blue loan, $10 million went into a debt service reserve account, and another $10 million covered transaction fees. Altogether, the creditors accepted a haircut of $252 million and a true reduction of $189 million for Belize at a time when Belize's debt to GDP ratio was around 125%. Because Belize's external debt stock in 2021 was roughly $1.45 billion, this meant the swap reduced about 13% of its external debt. So on the surface, this seemed a significant operation, a large-scale debt restructuring tied directly to conservation financing, and a model that has since been promoted as a template for other countries. Now, if we dig deeper into the Belize Blue loan, the numbers become slightly more complicated. In addition to the debt buyback, Belize also committed to several other outlays. These included annual marine conservation payments, management fees, insurance against natural disasters, and additional trust payments, all accounting for a total of $111.5 million. So when we account for all of these commitments, the actual face value reduction is not the $189 million we just saw, but closer to $77.5 million, equivalent to about 5% of Belize's external debt. Whether Belize is fiscally better off in the long run also depends heavily on the interest rate paid on the blue loan. So over 20 years, Belize will pay about $555 million to the BBIC in loan repayments on top of the $111.5 in the additional outlays. And crucially, there is no hard currency relief here since Belize still makes payments in foreign exchange. The only hard currency relief is the $4.2 million per year directed into the conservation fund. So while this deal has been celebrated as a landmark debt for nature swap, when we take a closer look, the gains for Belize are more modest, not much different from the first wave of swaps, and the long-term fiscal picture is far less clear. On top of this, another important factor in evaluating these swaps is the interest rate differential between the new blue and green loans and the bonds issued in the process. So take Ecuador. The loan it received carried an interest rate of 6.98%, while the bond was issued at 5.4%. So in other words, Ecuador was borrowing at a higher cost than the bond investors were lending. And this was also seen in the case for Barbados and Gabon's latest debt for nature swap. Now, the obvious question is, why does this gap between the blue bond rate and the blue loan rate exist? The difference is this is what covers transaction costs, including guarantee fees, intermediary costs, advisory, monitoring, reporting expenses, and other fees. In theory, this spread pays for the infrastructure that makes these deals possible, but in practice, many civil society organizations have pointed out two persistent concerns. First, there's usually a lack of transparency around these costs, how much exactly is being skimmed through the interest rate differential and who benefits. And second, without clear disclosure, it's difficult to assess whether these costs are reasonable or whether they eat into the fiscal and conservation gains promised to debtor countries. So when comparing the first and second waves of debt for nature swaps, it becomes evident that both ultimately fall short in adequately addressing both the debt and nature crises. The limitations of the newer swaps involving the private sector mirror those of the first wave, which faded due to their scale and ineffectiveness, while the newer swaps may appear significantly scaled up due to their packaging. A closer examination of factors like interest rates, transaction costs, fees, and the debtor country's contributions to the private sector entities' profits reveals that the savings may be rather insignificant. The conservation efforts also remain confined to the conventional approach of restricted resource use, lacking any true innovative solutions to really support this resurgence in their popularity. So the fundamental issue is therefore the need to reframe the swaps to clarify whose needs they truly serve. Given their inadequate responses to both debt and nature crises, the swaps seem to function merely as a creditor recovery mechanism enhanced with greenwashing. It presents a double win for creditors. They recoup funds that might otherwise be defaulted merely by accepting a haircut, and they can sidestep ODA and climate finance commitments by attributing the haircut as their contribution. This strategic maneuver allows the private sector to fulfill their CSR obligations while simultaneously leveraging financial innovation to create new avenues for private sector-led climate finance. This dynamic positions debt for nature swaps not as a panacea for the global South's interconnected debt and climate vulnerabilities, but as a sophisticated financial instrument that primarily mitigates creditor risk under the guise of environmental conservation. Now, how can these swaps be reframed and redesigned? So we can start with creating fiscal space, shifting the parameter of face value reduction to actively creating fiscal space, allowing countries to reinvest savings directly into their environmental and development priorities, integrating with development goals, ensuring that these swaps are deeply integrated with the country's own development strategies, guaranteeing additionality and coherence with the national vision for sustainable growth, ensuring equitable benefits, so designing mechanisms that ensure the financial savings and environmental gains from these swaps translate into tangible benefits for the population in the global South, rather than solely serving external conservation agendas. Prioritizing the equitable distribution of benefits, actively involving local communities, and strengthening inclusive governance to ensure that the advantages accrue to those most impacted, while actively dismantling the informal clientelist networks that illegally exploit the resources. And lastly, moving towards a more nuanced conservation efforts tailored to local contexts, backed by strengthened monitoring and evaluation frameworks to ensure long-term accountability and provide evidence for the necessity of the debt for nature swaps. Thank you.
So thank you very much. I just wanted to thank the three speeches. It was a very great discussion. Thank you.